Hi, good afternoon to you all, and sincere apologies for the late start of the webinar. I want to welcome you all to this afternoon's session. I'll quickly begin with the opening prayer and then invite Dr. Jemfi, also Jemfi, to give us the introductory remark. This is Edward speaking, please. So we pray in the name of the Father, and of the Son, and of the Holy Spirit. Amen. Eternal Father, we are most grateful to you for this day. We thank you for the gift of life, and we thank you for making it possible for us to hold this session. We pray for a successful webinar. In Jesus' mighty name, we pray with thanksgiving. Amen. So, welcome once again to this first webinar organized by the Ghana Medical Association Fund. I would want to invite Dr. Oseo Jemfi, the director, a member of the board of directors, to give us the opening remark, and we'll take it from there. Thank you.
Thank you very much, Edward. Thank you everyone for joining in. This is the very first time that we are starting our financial literacy series organized by the GMA Fund board. This is something that we thought of, that we should start a series of presentations whereby people get to know more, our members get to know more about the fund, and also learn more about their personal investment strategies and everything that has got to do with finance. We know that after the DDEP, a lot of us have been thrown into a state of confusion. We don't know what is happening on the ground. We have some monies, we don't even know where to invest them. We don't know where to put them. We don't know, can we trust the system? What should we do? We are still trying to find our ground. And so we decided to start the financial literacy program to help us gain more insight into the financial world, and also learn more about our personal financing and what we can do about it. And so this is our very first one. And we hope that you learn a lot. We hope that you tell your friends, your colleagues at work, so that subsequently they'll join the programs that we do. We are also open to questions and ways that we can improve on. And so at the very end, we would ask you to answer a few questions to help us improve on the program that we have done. Let's stay attentive and then listen to what Mr. Nee and Sowa has to tell us. Thank you very much. And over.
Hello. Can I be heard?
Yes.
Okay, so it's okay, then let me start. So good afternoon, everyone. My name is Ampa Sowa. Let me turn my camera on. Okay, it's not allowing me to turn the camera on, but that's fine. So good afternoon, everyone. My name is Ampa Sowa. I work with the Data Bank Group. Been there for, I think this will be my 20th year in different capacities. And also have the pleasure of being among the team that does manage the GMA fund. So we thank the GMA board and the IC for giving us this business all these years. And it's my pleasure to also walk you through these 25 slides that I've prepared on the topic that is before you. Also on this webinar is Mrs. Deborah Amakote. You may be more accustomed to her being at the AGMs, and probably at the end of this, we'll both be available to ask any questions that you may have. Just before I start, just want to be sure if I can be heard clearly, or do I need to speak louder?
You can be heard very clearly.
Awesome. Okay, perfect. So this is meant to be interactive, though during the presentation, I would be the one doing most of the speaking. About halfway through, we have a short 5-minute video we'll be walking you through. And then at the tail end, possibly before or after the Q&A, I have 5 multiple choice questions to administer to you in the hope of ascertaining whether or not I've succeeded in either instructing you properly or confusing you, in which case we may have a do-over. So without much ado, I will probably then just get started right now. So the learning outcomes as it relates to this particular session, I have a 5-point agenda. So I'm hoping to take you through Investing 101, really just to help you understand. For those that may be novices, I doubt that they may be, but for those that may be novices and investing is new to them, and an academic definition and then a reason as to why we actually do invest. And secondly, trying to find out how it works. You'd find out about the tools that are at your disposal, such as the power of compounding, as well as time. Time is your friend when it relates to investing, especially if you start early. And then investments broadly are categorized in assets. You'd find out the types of assets that are there, and then specifically what's available for you to invest in as it relates to this Ghanaian market. We'll touch a bit also on knowing thyself. Typically, there are 3 things that we tend to look out for as investment professionals when we are engaging with clients. We tend to look at one's investment objective, how long one tends to or wants to invest, and then what their risk tolerance is. In this particular case, I'll focus a bit more on the risk tolerance. And then finally, try to just bring everything home. And following the domestic debt exchange program exercise that took place towards the tail end of December 2022, what are the learnings and what practical things can we take going forward into our investment habits and how we invest? So that really is the outline, and I'll proceed from here onwards. This is just a short disclaimer I picked from my favorite podcast. So this, even though I'm an investment professional, I've stated how long I've worked with DataBank. This conversation is meant to be a general discussion on financial topics, and it does not constitute an investment recommendation or individual financial advice. For either of these, you need to speak to an investment representative of a fund manager, such as DataBank or any of the other ones that are out there. But these fund managers tend to be licensed by the Securities and Exchange Commission Ghana. So either of them are qualified to tailor-make a solution for you. And below are some of the information resources I tapped to prepare the presentation. Okay, so starting with what really is investing. So as it relates to finance in particular, investing is the act of committing money or capital to an endeavor, and it's not done just out of the goodness of one's heart. There's the expectation in doing this activity of obtaining additional income or profit. So if you were to put your money into an activity of sorts and it wasn't going to yield it, then I wouldn't really categorize that as investing. And investing is important for a number of reasons, but what I'd like to maybe get into as it relates to this are practical reasons why I believe investing is important. So why is it important? Well, for one thing, we all start work somewhere in our 20s. And broadly speaking, assuming you even started work at 30 because of school and whatever, you're expected to have at least 30 years of work experience, or 30 years of gaining or earning a salary. Now, it's inconceivable for one to expect to use the earnings from just work alone to survive while you work, and then even to survive after you retire. It's inconceivable if you're just going to rely on your earnings that you get just to do all those activities. For one thing, while you are working, depending on what age you are likely to perhaps have a family that you will be educating, a family that you'll be catering for. There are some assets you'll be acquiring along the way, such as perhaps a house or houses, a car, or some other types of property. And for those that are into legacy or planning the future for children and grandchildren, you may actually want to even leave an inheritance for them. Well, chances are that if you're just to rely on your earnings alone, it'll be difficult for you to achieve either of these things without doing some form of investment activity, be it in finances or in a real other type of investment activity. Now, when you retire, and I think in Ghana, the legal age for retirement is 60. When you retire, assuming you don't have a job or some kind of consultancy or side hustle or side gig at the end, all you're going to be relying on is pension. And in the current world in which we live in, as far as Ghana is concerned, we have, yes, the 3-tier scheme, in that you have your SNET, you have your tier 2, you may have your tier 3. For those that contribute to the fund, there's that as well that you can also rely on. And the point is, assuming like normal people, you retire and that is it. You don't say have any extra side hustle or anything to do. Within that, your retirement years, you're not going to be earning anything in addition to that. You're going to be relying on these, the savings that you've done or the earnings that you've done. If they were invested properly, it's your pension that you're going to be relying on as it relates to how you'll be supporting yourself in retirement. So imagine if, assuming you didn't have any investment activity, there was no pension, and you're just to rely on your earnings alone. By virtue of inflation alone, that is likely to even erode what little savings you have. I believe during the week, we had news of inflation coming out for the month of January. I think it came in at 23.5%. And that's quite high and quite elevated. It means your purchasing power relative to a year ago, it has eroded by more than a fifth of its value. So even if, let's say, you're looking away from financial investing and you wanted to do some other kind of a side hustle, say you have money to put into Uber, get a Picanto or one of those small cars, and you were to run that, or you have a mom and pop grocery shop nearby, or anything of the sort. I mean, you need these other sources of income to supplement your income. And what I'm here to submit to you is that regardless of the challenges we've had as it relates to the economy and DDEP and so on and so forth, you need to invest. You need to invest in some kind of a financial asset. And the importance of that is for all the reasons that I've said. Given that you're in the doctor's profession, you guys are in the medical profession, I can even go a step further to say that through technology and the way you also continue to upgrade yourselves, life expectancy, broadly speaking, has actually increased. And in the past, one may have expected the average Ghanaian to have lived maybe an additional, maybe 5 to 10 years after retirement, meaning that God forbid, or touch wood, people will be dying between 65 and 70 years. Well, guess what? Because of technology, better medicine and care, the average Ghanaian is actually living longer than they used to be in the past. Meaning that if your retirement was at 60, no longer are you expected to knock off in 5 to 10 years. There are some that are living as long as 20 years. So to the point, you are going to be earning for about 30 years, if you don't invest those funds in a productive activity of sorts, and you do live longer, there's some time down the line that you will actually hustle if you don't plan your retirement, or the way you live, or the way you earn, the way you save properly. So these are the raison d'etre for actually investing. It is necessary and it is important. Otherwise, you will not be able to live or survive as you get older. So what we are proposing to you is to actually have your money work for you. Have your money work for you. And how is that achieved? So this next slide touches a bit on one concept. It's called compounding. And technical definition, so compound interest. Interest is calculated on the initial principal and on the accumulated interest of previous periods. And over here, we try and give an example. So assuming you had just 100 cedis and you invested that in some kind of activity that was earning 5% per annum, and this was done a year. But this is going to be compounding yearly. After the first year, you expect to have 105 Ghana cedis. How do we get that? Your 100 is your principal, and then 5% on that principal translates to 5 cedis. So by the end of year one, you expect to have 105 cedis from that. Well, assuming it was to run a second year, the way compounding works is that not only will you have this interest working on your principal, but it will be working on the interest that you've earned as well. So by the end of the second year, instead of you having just maybe money invested on just the principal again, because you have added the interest to it, you would actually end up having 110.25 Ghana cedis by the end of the second year. And that is what compounding does for you. Compounding helps accelerate the rate at which your money grows. Now, when you add the power of compounding to time that you have, you get an even more amplified impact to everything. So you remember much earlier on in my example, I was saying that assuming you started working at 30 and you have to retire at 60, you have 30 years working life. If you add the element of compounding to this, chances are that you will actually be able to maximize your earnings a lot more than just to invest simply and not compound. So let me just give you an example. And over here, I'm taking two hypothetical people. There's Anna, who invests 15,000 cedis at the age of 20. And then there's Debbie, who invests a similar amount, but 15 years, she's 15 years older at the age of 35. Now, if they both plan on taking the money out at the age of 65 and they both earn the same amount of interest, just because someone started early or Anna started early, Anna is earning as much as almost 70,000 more than what Debbie is earning. Why? Because she started investing early and her money is compounding. That is what time and compounding actually does for you. Even though this presentation really is on strategies after DDEP and what's available, I just feel the need to reiterate this and the importance of this. Because over the course of our work, we realized that some people, even colleagues of ours, have become a bit disillusioned about the market, but we really need to continue at it. So really, as it relates to time and compounding, compounding accelerates your earnings power, it maximizes your earning potential, and you must leave the investment and interest end alone for this to happen. And I have a caveat in relation to this at the end that I will elaborate on. And when I get to that point, I'll probably cite it. So now into the meat of the matter as it relates to the presentation. Before we get into talking about personal investment opportunities and strategies after DDEP, I just feel the need to just remind people on the call, on this webinar, what assets are. Investing can broadly be categorized under two types of assets. Those assets can either be real or they can be financial. So as it relates to real assets determine the productive capacity of an economy and is used to generating material wealth. For anyone that may have done elementary economics before going to med school, you may have chanced upon these four. It's called for something of labor, for something of I've forgotten the specific term, but the four in particular that I'm referring to, which we define as real assets, are land, labor, capital, and I believe it's entrepreneurship. Those are the four things that were taught in elementary when we're doing elementary economics, and as being, I guess, the real assets that tend to drive the productive capacity of an economy. Now, financial assets are means by which people can make a claim on the real asset. So they are not necessarily, they may or may not necessarily be directly real assets, but the one thing that you can use to define for sure that a financial asset is what it is that you can, through that financial asset, a claim can be made on the real asset. Now, broadly speaking, if you look at the literature, the three that are often referred to are equities. Another name for equities is stocks or shares, which you may be familiar with. And then fixed income. Fixed income is basically anything in an investment that has a fixed term. Usually you get an interest on that for the period. The third category, mainly derivatives, that is a bit more complex. I'll not get into that because it's not really relevant for what we are about to do now. But those are the three broad common types of financial assets that there are. There's a second category of financial assets, which we broadly categorize as alternative assets. And I mean, if you're paying attention, as it relates to the GMA fund in particular, I believe there are allocations to these broad, at least the first two broad types of assets that I've discussed, the equities and fixed income. And then there's even an allocation to alternative assets that we have courtesy of the IC. Okay, so over here, I mentioned going a bit into more detail as it relates to types of financial assets, but I promised you at the beginning that I have a video to show to you, and that is what is before you right now. Before I start elaborating on the types of financial assets, I will play the video for you to see. It's less than 5 minutes in length, so please pay attention, and then we'll get about doing it. Okay. Can you hear the sound coming from this? Edward?
No, please.
You can't hear anything. Okay.
No, we can't.
One
Sorry.
moment. Okay. Hold on. Can you hear now?
Risky run on your investments. The safest.
Yes, it's clear now. We can hear.
Starting again.
Okay, there's no sound now. We can't hear any sound from the video. Sorry.
Okay, my apologies. I'll see what I can do.
What are the basic investment products? Usually there is a trade-off between the return you can make and the risk you run on your investments. The safest investment choice is cash held in an easy access or fixed-term savings account. This is especially true as you get nearer to retirement, when you need more financial stability and it's more painful to recover from an investment gone wrong. While holding cash is a relatively safe.
Okay, I think I'm having an echo because of what I'm doing. Give me a minute or two to figure this out.
No, we can hear now.
Apologies.
We can hear now.
Yeah, but you can only hear because I have my mic on and it's creating that feedback. Okay, actually, I know what to do. Hello?
Yes, hello.
Yes. I think the video is. Sorry, I'm just trying to mute. Okay. So the video is done. I'm not sure if you guys heard. If you didn't, I'm really sorry about that. But after I'm done, I will probably send this to the secretariat, and it can be forwarded to members. But what I was trying to achieve as it relates to the video was to just walk you through what types of financial assets there are. As it relates to Ghana in particular, we have mainly fixed income and then equities, also known as stocks or shares. And what we'll be following would be short presentations on each of these types of financial assets. So as it relates to fixed income, really what you have is an entity that is usually lending money to an entity that could be an individual or a company, lending money to an entity which is usually referred to as an issuer or a counterparty. And that counterparty then is responsible for, I guess, investing the money in an activity to be able to generate a return for you over time. The entity in question that could receive this money as it relates to fixed income could be a government, in which case, in Ghana's case, is the government of Ghana, or if it's not the government, then it will likely be an entity that is licensed by Bank of Ghana. And in this category, you usually have two broad types. There are banks, and then there are non-bank financial institutions. Or you can release it to a regular company, in which case the types of securities that they would issue to you in return for you giving them money could be either termed as commercial paper or corporate bonds. So these are the broad categories under fixed income. Now, over the course of your investment activity, you may have come across a term referred to as money market. Money market is a subcategory of fixed income, but for money market, the length of time is usually short. It's usually a year and below. So if you ever do any fixed income investment that has a tenor of, say, 91 days, 182 days, up to 1 year, all of that is generally categorized as money market. And anything that is longer than 1 year is usually when we return that to be fixed income. Now, for stocks or shares, these represent part ownership of a company. So if you have a share in a company, it means you're a part owner in the company. And that also gives you a right to do a number of things. You own it, so you have a claim on its earnings, you have a claim on its assets. If a company declares dividends, you'll be entitled to some in proportion of the amount that you hold, the amount you control in that particular company. And shares can either be publicly listed, or there could be some shares that are unlisted. So case in point, on the Ghana Stock Exchange, for instance, you have some, I think 30 companies or so that are available to the public for you to buy and sell at will. And some of the names of the companies that are listed there, some of you may be familiar with. There are other securities that are also on the Ghana Stock Exchange. There are preference shares. These are shares that have some qualities that resemble fixed income. On the Ghana Stock Exchange in particular, we have one preference share that is, I believe, issued by Standard Chartered. And then we also have one exchange traded fund. This is sponsored by an Absa vehicle, and I think the underlying really is gold. I'll not get into that at the moment. As it relates to collective investment schemes, and the video had referenced that in terms of funds. In Ghana, the collective investment schemes can either be a mutual fund, which is a company on its own, or it could be a unit trust, in which case it's governed by a trust. Personally, I tend to prefer the mutual fund structure because it being a company on its own means that it has a board of directors, and elements of its governance seem to be a bit more stronger if it's structured as a mutual fund rather than a unit trust. That said, my review of it has also shown that mutual funds could potentially be a bit more expensive to run because of all these other governance setups that exist to make it hold. So over here, I think we just elaborate a bit more on what fixed income is. What I would want to do right now is to maybe just help you, like after this session, when you are, I guess, going about your daily activity, you can look at things around you and it could resonate with you a bit more. So earlier on, I think I talked about fixed income. Like it could be the government that even does the issuing of that particular fixed income security. Over here, what I'll probably do is to just project. Okay, so over here, okay. So the government of Ghana, when you see your treasury bills, your 91-day treasury bill, your 182-day treasury bill and stuff, that is the government's way of borrowing from the market. And it's a money market security if it is under a year. And we can establish that 91 days, which is basically 3 months, is under a year. 182 days is basically 6 months, which is under a year, and 364 days, well, it's just about a year. So each time that government comes to market to issue treasury bills, and that is usually done, I think, between Thursday and Friday. And then on Friday, they will usually publish this document on their websites. It's the auction results. And if you are not too web friendly, on Mondays in some of the daily newspapers, in particular the Daily Graphic, the Ghanaian Times, and I believe the Business and Financial Times, you will see this very sheet showing you the results of the auction that took place. So as you go about if you are interested in closely tracking, say you are to even buy these treasury bills or so from your bank, one way of easily determining whether or not you are actually buying something from the bank or whether it's the bank selling to you is whether or not you are actually being given the interest rates that are being quoted over here. Because it's perfectly possible that the bank or wherever you're buying it from may be buying it on their books, and then they'll be, I guess, selling it to you potentially at a yield that is lower. So that is one way by which you could even check or verify whether or not, if you do engage in the purchase of Government of Ghana treasury bills, as to whether or not it actually is yours. So this is available for you to potentially get exposure to. In the spirit of everything that has happened as it relates to the domestic debt exchange program, there's been a lot of debate as to whether or not even treasury bills are safe. I have a personal view as it relates to that, but the only thing, if I was asked a question as to whether or not they were safe, all I have to say to you is that, I mean, when it comes to these securities, you cannot, it's not a different government that is issuing this. It's the very same government that, the same sovereign that issued the bonds that were restructured, that is issuing the treasury bills. they are all homogeneous. You cannot distinguish between them as far as the issuer is concerned. And for me, what also slightly concerns me is the fact that for the bonds that were exchanged to be, and then in return we were given these new bonds, a number of those old bonds had coupons that were lower, significantly lower than the treasury bill rates that are currently being floated at. So why would I, person, that's the question I ask myself, why would I want to engage in purchasing treasury bills if those rates are higher than the bonds that were restructured? For me, it doesn't. That's a question I've been struggling to answer or trying to get my head around. It doesn't make sense to me. And if I do elect to look beyond that and to buy treasury bills, then that is I should do that knowing that it is perfectly possible that at some point in time, despite assurances that may have been made, by virtue of the math alone, it is possible that treasury bills could suffer a similar fate that like the way the bonds also suffered. Now that said, I mean, as a professional, what I would say is that the financial options available to government are limited. They are limited. They may not be able to borrow on the international markets. They cannot borrow on the domestic capital markets through bonds. So really what is available to them would be, I guess, IMF, the treasury bill market, and then GRE, whatever revenues they are able to do so. So it's also possible that because the avenues to access financing are limited, that is why the rates are high. But that's the way, but you need to look at it from all angles just to be sure that you know what you are doing before you get into it. So I hope this gives you sufficient enough color as it relates to that. Away from treasury bills, but still sticking to fixed income, there are other things that I would want to show to you. We talked about corporate bonds. So let me just briefly display. Okay. So this is a corporate bond. I mentioned a company could issue corporate bonds. And so over here, we have the prospectus for Casapreco. Casapreco, you may know to be the producers of products such as Alomo bitters, Awake water. They also produce a number of carbonated soft drinks. They're a total beverage company. Now, late last year, they secured approval from the SEC and the GSC to raise some money through the capital market. And given that they are looking to raise money, which is longer than a year, they are basically raising a corporate bond, which qualifies as fixed income. And so this is just an example of a company that has gone ahead to issue a security, a corporate bond, to raise money for the market for its own purpose. So I hope this also just gives you color as to what is available. Let me switch back to the presentation. So we're more or less done with fixed income. I will go into just giving you examples once again in terms of computation. So over here, assuming you are looking to invest in treasury bills, if you decide to buy 1,000 cedis worth of treasury bills to be paid back in 182 days, the interest basically that is being quoted for is 20% per annum. Now, when you hear a rate being quoted in the market, the convention is for the rates to be annual. The market convention is for the rates to be annual. So, but you only get paid for the length of time in which you actually hold the security or you hold the bill. So if 182 days, we've established is 6 months, and that 6 months is half of a year, then so long as you are holding 182 days, you will not get the full 20%. You will only get half of the 20%, which is why over here, even though you've computed what the interest would be for a full year, which is 200, for the 182 days is actually half of that interest, in which case by the end of the 182 days, you'll be paid back your principal, which is 1,000 Ghana cedis, and then your interest over the 182 days, which is 100, totaling 1,100 Ghana cedis. Now, assuming you were to invest in a bond, call it a Government of Ghana bond or even a Casa Preco bond, as we've established. Bonds, over here, the example is the same as it relates to a principal, but the length of the bond in terms of term is 10 years. And this bond is promising to pay 20% per year. So each year you have to earn 200 Ghana cedis on this. And for the 10-year period, as it relates to interest alone, it will be your 200 times 10, which is your 10 years, totaling 2,000. So by the end of the 10th year, when it matures, the company or government in question should be paying you back your principal, which is 1,000. And then over the period, you would be paid 2,000 Ghana cedis in interest. But on the maturity date itself, you're likely to receive your last coupon, which will likely be 200, plus your 1,000, which is 1,002. But in all, you should be expecting 3,000 Ghana cedis, being your principal and then your total interest over the period. Okay, so we are done with fixed income. This is getting us into shares, and I think I touched a bit on what they are. They represent a part ownership in a company, and they generally also tend to be volatile. The price tends to fluctuate frequently on a daily basis. In some markets, we have what we refer to as circuit breakers that limit the extent of rise and fall that a share price can obtain in a day. On the Ghana Stock Exchange, the limit to a share price going up and down in a particular day is, I think, 10%. So in a day, the price can't go beyond 10% in terms of rising or go below 10% in terms of decline. Now, why do companies issue shares? In part, you can use it to raise money to for a variety of reasons. Some are looking to raise money to reinvest in their business for it to grow. Others are looking to sell their business and take money off the table and take money out. And I mean, like I said, the reasons tend to vary. If you look at some notable examples of companies issuing shares, the one that maybe comes to mind readily would be the likes of Scancom PLC. That is the official name for MTN Ghana, the company that trades as MTN Ghana. And I believe it was 2017 or 2018, they came to market to issue shares to Ghanaians in particular. Why? I believe as part of their licensing requirements with the NCA, they are required to have at least 25% of the company being owned by Ghanaians. So to fulfill that, because it's a South African company, to fulfill that particular requirement, they could have privately sold a chunk of their shares to a consortium of investors, institutional investors, but they elected this time around to just float onto the Ghana Stock Exchange to maximize the ownership being in the hands of the average Ghanaian, most of whom use their products and services. I believe as we speak, MTN has the largest shareholder base in the country, north of 120,000 shareholders, and it's by virtue of them going public and selling a part of the business to the public that they were able to achieve this. If you wanted to independently verify this, just to show you, every day. Part of what we receive, and being in the markets in which we are what we refer to as an official list or market summary. It shows you what the index is basically a measure of how the entire market is performing. And year to date, as of February 16th, the index is showing a growth of 1.77%. But over here in this sheet in particular, you get to see the number of companies and various statistics on each of them. So this is what in part we tend to use to do our everyday work as it relates to investments in the stock market. Okay, so I'll probably stop and then reshare the presentation, I think. Okay. So earlier on when we're talking about fixed income, we mentioned that you can get paid in the form of interest, also known as coupons. The funny fact, the word coupon used to come from the fact that you'd actually have it like a perforated paper and coupons that you can tear off that and submit to get your interest actually paid. So if you see the word coupon, it actually did used to be a coupon when back in the day when fixed income was first introduced. But the equivalent, I guess, income that you get from stocks as opposed to fixed income is what we refer to as dividends. And dividends is basically money that are paid to companies, to shareholders, and it's usually out of the profits that a company makes. If a company doesn't make profits, it's very unlikely that they would actually pay dividends. And the thing with shares is that they tend to be, we've already talked about them being volatile in terms of price movement. The risk, though, is that if a company does go bankrupt, it's very difficult that there would be any assets to claim that shareholders can actually claim. And it will be very difficult. Why? Because especially if that company that has gone bankrupt also has any obligations in terms of fixed income or debt. The way it works in finance is that the debt holders will actually get paid first before equity holders will get paid. So if a company goes bankrupt, the shares tend to be deemed worthless. An example I can give to you, for instance, even though that process isn't complete, it relates to UT Bank. So UT Bank, as you know, used to be previously UT Financial Services. It was listed on the Ghana Stock Exchange at the time that its license was revoked. And I think the GSC subsequently delisted it from their market. But there's no price that you can even attach to it to try and see if you can even get your money back as an equity holder. So anybody that is holding those shares, you can more or less consider them to be it's worthless. Okay, so I realized that in terms of time, I need to move a bit faster so that we can conclude this presentation. And over here, I think we are touching a bit on collective investment schemes. So what are they? They are usually an investment vehicle that consists of a pool of funds that are contributed by many investors in order to invest in a variety of financial assets. Those assets could either be only stocks or only bonds or only money market securities, or it could be a combination of either of these. So you may have maybe heard of names such as EPAC or M-Fund or the Stanbic Income Fund Trust or the EDC Fixed Income Trust. All of these are examples of collective investment schemes that are licensed by the Securities and Exchange Commission. They pool funds from a variety of investors. I can say that in the case of, in particular, M Fund, at a point in time, we had as many as 200,000 investors in terms of people contributing to this fund. And in the case of EDC, I think at a point in time, they had as much as 80,000 investors contributing to these funds. So these are, I mean, on their own, on a number of individuals that contribute into these investments it may be impossible for them to have or get ownership in certain companies. Why? Because they just wouldn't have the financial power to do so. But if you join a scheme like this, it is possible for you to actually gain exposure to some of the companies in question. Just the pluses I've cited, economies of scale, being part of it. Yeah, I also have small investors being able to invest in some large and well-performing companies. The downsides could be the fees, and fees tend to limit profitability. In the West, competition has succeeded in bringing these fees down, but as it relates to our markets, I think the fees still kind of remain elevated. I think it's a condition of the market, but who knows, maybe DDEP would turn things around. Okay, so we've broadly discussed investing 101, trying to find out the reasons why one should invest. We've talked about types of financial assets. And right now, I think there are just two more aspects of this presentation that I'll tackle, and then we'll be done. These next two slides touch a bit on knowing yourself, and particularly as it relates to risk tolerance. So a lot of people, if you ask them a hypothetical question as to whether or not if they invested today and tomorrow their money doubled, how would they feel? And for a lot of people, when you ask them that particular question, they'll be very excited and happy. I mean, who wouldn't be happy if when they made an investment today and tomorrow the money doubled? And of course, it will make a lot of people happy. And then subsequently, when we've asked such people, okay, so what if on the second day of your investment, the money that had doubled then just drops by 90%? How would you feel about that? Now, for some people, depending on their temperament, they may be not too concerned. Why? Because they may understand investments and may be in it for the long term. For others, they'll be alarmed and maybe just question or second guess their investment move. And then for other people that I know, some people may not sleep. Their BP would go up. They'll be worried. And probably the very next morning, they will probably be at their place where they made the investment trying to redeem their funds. So it's important when you're doing your investment that you should know yourself and know what your tolerance for risk is. If you are in it for the long haul, chances are that you may not be reacting too significantly to wide gyrations in the price. Why? Because you're in the long haul, and in the long run, if the investment is really good, chances are that it will perform well. However, if you are the type to be extremely concerned with these wild gyrations, then there's a good chance that your tolerance for risk is low, and as such, it would be good for you to invest in something that is not as volatile as shares or maybe even bonds. So in sum, as it relates to risk tolerance, you should really, once again, determine what is suitable to you. And there's not a one-size-fits-all strategy. There's no right or wrong way to invest. It really depends on the personality and what you can take or tolerate. If you have the capacity to take on risk, then yes, by all means, you can do so. if you think it will benefit you. But if you don't, then you should advise yourself accordingly and align yourself to investments that have a low degree of variability. Okay, so we're in the home stretch now, and probably the next few slides touch on reason for not just having or putting all your eggs in one basket. And you know that proverb. I mean, if you're running with that one basket with all the eggs in, chances are that if you trip and you fall, you're at risk of losing all the eggs that are in that particular basket. And so it's important for you to at least try and diversify, put your assets into a variety of baskets. If you take your risk tolerance into consideration, and then in conjunction with your investment objective and the length of time you expect to be invested, you can either choose to have a high allocation to risky assets, or vice versa, depending on what your preference really is. And at this point in time, I would like to reiterate what I said at the beginning as it relates to the disclaimer. I think if you really want to be serious about this, it will be good for you to have a conversation with an investment representative of a fund manager. They are qualified to be able to advise you appropriately on how to move. All they will do is advice. The decision-making, however, has to rely solely on you to actually make the decision to move on. Now, the third major bullet point on this particular slide, I think is actually interesting. So when you're doing portfolio diversification, it doesn't just mean take different assets and put them in different baskets per se. It's important the types of assets that you actually take and you combine to form your portfolio with. So let me give you an example. Assuming you wanted to invest in, let's say, banks in Ghana, and by virtue of what has happened as it relates to the domestic debt exchange program, we know that banks had some exposures to it. So if you just blindly put your monies in all the banks, chances are that you could be impacted adversely as a result of the DDEP. Even if you are an equity investor and you are going to rely, you may not have lost anything as it relates to fixed income. As an equity investor, there's a good chance that you could suffer, especially if you rely on the dividends that these banks pay. Why? Because guess what? As part of the forbearance measures that Bank of Ghana introduced to give the bank support, they actually outlawed that banks should pay out dividends for a period of time. So for the next year or couple of years, the banks that are around are unlikely to be paying dividends so long as they are taking advantage of those forbearance measures. So yes, you may have banks that may be in different aspects of the market. You may have your blue chip multinational banks that are catering to corporates. You may have some that are catering to SMEs and so on and so forth. But if you wrongly combine investments like that, chances are that when there's a significant negative occurrence in the market, that your even though you thought you were aiming to diversify, and chances are that you will not be able to achieve that. Why? Because they are really just the same, but they may bear different names. So to the point, if you're going to create a portfolio of different assets, yes, it will be good to have some banks in there. You can look at other industries like oil marketing. You can look at telecommunications. You can look at food, and so on and so forth. At least the way some of these industries work and sometimes are kind of disconnected from certain systems, chances are that if there's a significant impact on one particular industry, that other industries may or may not be a bit insulated from that occurrence. So that's what I'm hoping to achieve. Okay, so I have probably maybe 3 or 4 more slides to go, and then we can take Q&A. I see that currently there are about 28 questions and answers outstanding. Hopefully I'll have enough time to get through all of them if they are addressed to me. So yes, the first strategy I'd like to touch on as it relates to this, and is that assumptions kill. Assumptions kill. For people that know me, I like to watch TV when I'm not working, and download shows and watch TV. And one of the shows that I've come to like, it's called Reacher, and it's an adaptation of a book. But I think the main character, his name is Jack Reacher. Some of you may know that Reacher character was earlier on played by Tom Cruise in 2 movies. This is a TV show, and it's played by this guy. Now, one of the lines that he likes to use is assumptions kill. And I thought that line resonated with me. Why? Because pre-DDEP, we had a lot of assumptions about how the Ghanaian economy works or is supposed to work. So, for instance, I believe in 2022, when we first started seeing stresses on the Ghana fixed income market, when we realized that we will not be able to access the Eurobond market to get hard currency to run the economy, we felt that, you know what, if there's going to be an issue with the economy, worst case scenario, we are in control of our own fate as it relates to government of Ghana securities. Why? Well, those government of Ghana securities are issued by the Ghana government. Our own central bank owns the cedi and prints it. The government of Ghana has never defaulted on any of its obligations. It is risk-free, or I guess the technical term for it is zero risk. So that assumption holds true because it has never happened we've never had a reason to question it. And so nothing can go wrong. We saw people piling into government of Ghana securities even more. In some cases, in some pension, MPRA licensed pension schemes, and some collective investment schemes, and some insurance portfolios that we've seen. Some would even go over and above their regulatory limit because of this assumption that government of Ghana is risk-free or zero risk. And as we all saw in December 2022, things happened. The currency, we may own it, but we can't print it freely. Bank of Ghana actually started reining in and rather raising rates to take out money from the system. And now the IMF has even imposed a limit to how much the Bank of Ghana can print money to support the government. Previously, it used to be a certain percentage of previous revenue, but now that has totally been closed out. So government cannot print money anymore to support its budget. And we are left with the result, trying to tighten our belts as much as we can. So assumptions kill, and so we need to be careful. How do we get ourselves out of this mess? In my view, the solution or strategy really is education. I think we should question the assumptions. We shouldn't just take things on face value. We should educate ourselves a lot more, be aware of things that are going on around. If you see the signs of stress, the result is not to pile in and double your exposure. And I get, I mean, to other people, people may have questioned because of events that happened before DDEP as it relates to the financial sector cleanup, the way banks and non-banks went down. I can understand why people would have arrived at the conclusion to increase the exposure to government of Ghana securities. Why? Because that is something that they know and then they are safe. But that assumption can kill. And as a result of that, I mean, individuals were not the only ones that were caught in this. As I mentioned, banks made that assumption. We saw some NPRA licensed pension schemes making that assumption. We saw insurance companies making that assumption. Indeed, even collective investment schemes, which I know even the company that I work for, that's issue, we even got caught in that as well. So those assumptions kill. We need to educate ourselves and be aware of what is going on around us. Question the assumptions. That is another. And then we should read and be aware of things that are going on around us. I was very surprised when I learned in the heat of the men's gold saga, that even after there were all the very public things that were going on, there were people that were there that were still trying to take money there. I mean, what were they thinking? What were they thinking? You need to be aware of what is going on and educate yourselves, even if it means reading and listening to certain podcasts, reading news, and granted, as doctors, I mean, your CPD and everything may be focused on improving your knowledge in your craft, but you can easily also take a course on financial literacy on your own and be more aware of the things that are going on around you. That is one strategy I think we can employ. The second one that comes to mind relates to going global. So you'd realize that this slide is similar to what I think I had on slide 9, where I talked about the various investments that are available in Ghana. But by virtue of the significant development in DDE, I mean, nearly everything got impacted. Yes, fixed income got directly impacted. Company shares got impacted. Why? Because some may have investments in Government of Ghana securities, or maybe may have dealings with companies that may have investments in Government of Ghana securities. And I've already talked about mutual fund exposure to same. So maybe a way in which we could look to, as a strategy, moving away from being significantly impacted by the DDEP in Ghana is to go global. Go global. Why limit your investment universe to Ghana and Ghana alone? If like the DDEP that we've spoken about, the US isn't experiencing that. They may be facing a different number of things, maybe on geopolitics, Middle East tensions. There's always Russia in the background. There's China over there. But at least if you go beyond the shores of Ghana, you give yourself a chance to diversify away from Ghana and potentially improve your return, or at least improve your risk-adjusted return as it relates to this. The images that I have over here, I think this green one relates to Bamboo. It's an app that facilitates you trading in other markets. Standard Chartered also has some solutions of that nature. And I'm not here to promote. I'm just saying that these are channels that are available. If you want further and better particulars, you can speak directly with these ones. And then Axis Pension, they have a wealth management subsidiary that has recently acquired that functionality as well. These are ways in which you could easily go global as it relates to your investment strategies going forward. And then finally, my third strategy that I would recommend, and this you should probably appreciate a bit more because of the profession in which you are in, is to have an annual health checkup. I mean, for the longest time, I've been told, I have a cousin who I think may be on this call. He's been bugging me to have my annual medical checkup. It's been 2 years and I still haven't had it. But there's that recommendation for my general health, and I believe some dentists even require you to do that every 6 months to have your teeth checked. Well, why don't we have from a financial perspective, have a regular financial health check. Why don't we have that? I mean, incidentally, as I was preparing for this particular session, I realized that, I mean, legally speaking, the company's code or registrar generals require companies or entities to report annually to their investors. Fortunately, the GMA fund, which we manage, which you guys are part of, we hold AGMs each time you guys have your sessions. You should be paying attention to those sessions and use that as an opportunity to check on your investments. As it relates to your person, depending on the type of investment that you have, if you have shares, especially in a public company, or you have investments in collective investment schemes, these companies actually hold AGMs. And some of them, at least on the collective investment scheme side, by law are supposed to report to their shareholders at least twice a year. They should be producing half-year financials as well as half-year statements of accounts to their shareholders. So you should take advantage of those things and track your investments. Once again, ahead of this meeting, I was just sharing a few thoughts with Debbie, and I realized that there was an entity that I help manage, and for the longest time, I realized that some of their fixed income investments had been running for years. When I say years, the earliest that I could find for one was as far back as 2002. We are in 2024, 2002, and we are in 2024. That fixed income investment has more or less become equity when it shouldn't be. The way you get to check and see how an investment is performing sometimes is not just to drop it and leave it and forget it totally. You should be having those regular checks, and at times even test them. Test them. What does testing mean? You may have on it an instruction that, yes, it should be rolling over with rolling over with interest. At times, you should actually stop that instruction and say, okay, why don't you pay me at least my interest? Or a more extreme measure, pay me my interest and half of my principal. And when that happens, that test doesn't need to result in just, okay, they've paid me, okay, then let me send the money back. When the money comes, let it cool off, let it breathe in your account, or find another investment avenue to divert it to as you are doing your test. All of these would help you in this post-DDEP era so that you can have better monitoring as it relates to your investments. So I have probably just 2 more slides to conclude. So I've touched on time, I've touched on compounding, and they are both your friend. And that's why what I just said about breaking your investment or testing, I think compounding and time does still work for you. Risk tolerance, you should know yourself, know what you can tolerate in the context of your investment objective and how much time you intend to be invested for. Portfolio diversification is key. It's not just spreading your eggs into many baskets, but even the types of baskets you choose. It's very important. And then as it relates to your strategies post DDEP, assumptions kill, go global, and then try to have an annual health checkup at least once a year. I have a big sister, proverbial big sister at Bank of Ghana that schedules her medical appointments around her birthday. And I've tried to do that. Like I said, in recent years, I've been unsuccessful at that. But I hope at least this year to strive to do so later in the year. So that more or less is it for me. And thank you for the opportunity to address you. And if there are any questions, I'll be happy to take them. Deborah is also on the call. So if she's in a position to take the questions as well, we'll do that too. Thank you so much.
Okay, thank you so much, Ni. Ampa Sowa. So for the presentation for this evening, he has been able to take us through the types of investments. He's touched on personal investments as well, and then opportunities after the DDEP. And now we'll take the questions and would say that because time is not our friend today here, unlike time being our friend in investment, would want you to type the questions so that there will be no oral presentation or asking of these questions. So without much ado, would go to the questions. I've sipped through some of the questions. Some have to do with GMA fund and other things. I'll plead with all of us that would read out those that are really relevant to the presentation. And then when we have some more time, we can take on some others. So quickly, the first one is coming from Roderick Larsen-Randolph, our immediate past chairman of the GMA fund. So he asked, Ghana has run an average inflation of 17.4% since 1988. What is the cumulative effect of this on 100 cedis over 10 years? So Ni and his team, you can begin preparing that. I'll read maybe the first 3 or 4, so you can have an idea of how you'd want to match them if there is anything like that. Okay, so then the next one comes from Joel Afi. Okay, so a question, he was just trying to mention that the 4 factors of production when our panelist was struggling with what it was. Then following that, would have a question from McCaffrey Dawei. So he has 3 questions. I don't know, he or she. All right. What kind of investment product works with the principle of compound investment? That's number 1. Then number 2, do products like T-bills and bonds accrue compound interest over the years? And 3, how can one invest in precious metals, into brackets, safely and securely in Ghana? I'll take the last one, and then you can begin answering them. So Richard Wuda Seme asked, please, Ni, did the DDEP affect mutual funds with data bank like M-Fund and EPAC, etc.? So Ni, if you and your team can begin answering this first few questions, then we'll come to the second round. Thank you.
Okay. Thank you, Doc. So let me start with Dr. Randolph's question, Larsen Randolph's question. The one on inflation averaging north of 17% and the cumulative impact on 100 cities over 10 years. Chances are that, so what we are really referring to is, assuming your 100 cities is uninvested and just is remaining in nominal terms, then the purchasing power ability of that 100 cities would be significantly depleted by the 10th year that you are referring to. I haven't worked the math out, but my guess is if it's really at 17%, your 100 cities would actually be worth approximately, and I could be wrong, but approximately about 10 cities or less in terms of purchasing power by the 10th year. Deborah, you can work it out and confirm, maybe type the response over there. But that's what comes to mind. As it relates to the question on, I think this was by McCaffrey, what kind of investment products work with the principle of compound interest? I think the mutual funds have that ability, especially if the mutual fund in question invests in money market securities. Money market securities are those, they're like fixed income, but the maximum term is a year and below. And because of that, they are not subjected to volatility of bond prices, which because of the mark-to-market directive from SEC, that would actually impact. So money market collective investment schemes, broadly speaking, I think will help you as it relates to this principle of compound interest is concerned. Your second question, do products like T-bills and bonds accrue compound interest over the years? So maybe just to clarify, as the whole thing with compound interest is if you leave your interest if your interest works for you. So if you are investing for a multi-year period and you are reinvesting the interest along with the principal, that's when you get compound interest working for you. So to the point, if you have an instruction to roll over your principal and interest on your treasury bill or bond, then yes, you can earn your compound interest on as a result of that. Dr. Kutuapa, you had wanted to answer the question on precious metals. Do you want to tackle that now, or would you want me to touch on that?
I'm not answering that question. You can quickly touch on it, please.
Okay, sure. So, I earlier on referenced exchange traded funds. We have one that is on the Ghana Stock Exchange. It's called the Absa New Gold Exchange Traded Fund. So the way it works, basically the underlying investment is in gold. So you don't get to actually hold the gold, but by virtue of holding that security, you more or less have a claim on a portion of gold, which the investment, I think, stores that gold, I think, somewhere in London, with a custodian in London. That from a financial perspective, in terms of success, safely investing in precious metals, that is what I can point to as being able to achieve safely in Ghana. But I think there's more to it that meets the eye. And once again, if you want to know more, I would recommend that you speak to the investment representative of an SEC licensed fund manager. So that answers the questions from McCaffrey. I think there was a question on the DDEP affect mutual funds. Yes, so in as far as the funds in question had exposure to Government of Ghana bonds, yes, it did impact. So bonds had to be exchanged, and the ability, the tradability and ability to realize liquidity did also significantly impact those funds. But it's something that we are still working at, and I believe for some clients that things are a lot easier now. I think that's what I can say as it relates to that. So Richard, I hope that answers your question. Dr. Kutuapa, I think I've answered the first round of questions. So if we can maybe take another batch, that would help.
Okay, so we'll go to the next batch of questions, and I'll start from the question from Habib Ahmed. So he has 4 questions, in fact, 6 questions. I think he has 99 questions for you in the end. So we'll go the first one. Can one buy a stock without going through a stockbroker? That's the first one. The second one, is there an app to use to buy stocks? 3, locked up funds in banks. What is the redress? And then 4, dividends are not paid these days. making buying of shares unattractive. So maybe you can have a comment there. Then he continued.
Okay.
DDEP stroke bonds, how different is it from T-bills? And then the final one, bond coupons, what are they? I think he just wants a rehash of that. Then
Okay.
Felix Ahosu comes in and says, what is the difference between stocks and shares? And then we have one from an anonymous attendee, which I usually would not read, but for today I will. What other financial institutions are there to buy financial assets except banks if sovereign economic processes place a significant risk on banks? Then 2, can we get a lay person step-to-step approach to purchasing of financial assets, say shares on the Ghana Stock Exchange or corporate bonds? And what are the options for where dividends and coupons are paid? I think we can take this set of questions and then we'll come back for another set. Thank you.
Okay. Thank you very much. So to answer Habib Ahmed's 6 questions. So on the first one, can one buy a stock without going through a stockbroker? The answer is no. The way it's set up, we have there's the Ghana Stock Exchange where the companies are listed and are licensed in terms of trading, but only stockbrokers have the ability to buy and sell shares. So as an individual looking to buy or sell shares, you must have an account with one of these licensed stockbrokers in order to trade, to buy or sell the shares. Now, closely related to that question is the second one on whether or not an app can be used to buy stocks. As things stand now, I don't know of any apps that can allow you to easily buy and sell shares on the Ghana Stock Exchange. But say there was one, that app will need at the back end to be connected to a licensed broker who is connected to the exchange for you to do the buying and the selling. So in short, in terms of responses to questions 1 and 2, you cannot buy and sell shares alone. You will need to go through a stockbroker to do that. As it relates to your third question, locked up funds in banks, what's the redress? I believe that there's a complaints, there's a procedure for registering complaints for most financial institutions. You would typically write to that institution, wait for some time to pass, and if that time elapses and you haven't heard anything, you then escalate it to their regulator to act on your to try and address the issue. If you're not hearing anything from the regulator, you can then elect to perhaps pursue court action, in which case you engage a lawyer and then you start that process all over again. But because you would have gone through the earlier reporting requirements to the company and then to the regulator, that could serve as evidence when you are engaging in a court that you have actually tried and yet you didn't get any feedback from them. 4, on dividends not being paid these days, making buying shares unattractive. So I think that assertion is relative. Companies are not obligated to pay dividends. Dividends tend to be paid, like I said, they're paid out of profits. Now, if a company makes profit, if you were on the board of the company, the decision of the board would be, okay, if I decide not to pay dividends, it's another way of communicating to the market that I have seen more investment opportunities in the company itself, such that I want to invest everything I have earned in the company to grow it further. So if that's the approach that you adopt, then as to whether or not you receive dividends in your hand, it's neither here nor there. I would expect that companies that reinvest their profits fully into the company would more or less communicating that I'm seeing opportunities in like in the market, and I think this decision to not pay dividends or to reinvest is a good thing. That's one way of looking at it. On your last two questions, DDEP bond, how's that different from a treasury bill? I mentioned treasury bills, they have a maximum tenor of about a year. Anything that has a tenor that is longer than a year is a bond. And I believe as it relates to the DDEP bonds, we have, at least for the pension fund schemes and then individuals that participated, that exchanged their bonds, they have tenors. I think there's a 2027, which is about a 4-year bond. And then there's a 2028, which is a 5-year bond. Treasury bills, they usually have, they're denominated in days. So 91 day, 182 day, and then 364 day bill. Bond coupons, what are they? So a coupon, broadly speaking, is just the interest that a fixed income security is paying. So a bond coupon is basically the interest that the bond is paying over time. I hope that answers those questions. So okay, just looking to see. I think I've lost track of the questions. I think a number of them have been answered, but
yes, we'll go to the next set of them. I'm also losing track, but just a moment so that I can be sure where we are currently. Okay, right. So, Richard Ampa, thank you so much, Odadeni, for the wonderful presentation and education. What is your advice on the many insurance policies for funerals, life insurance, education, etc., as a good form of investment? Then I'll go to Richard. He's asking, please, what are some of the specific investment opportunities that have compounding interest? That has been answered already. And then anonymous attendee. How easy or difficult would it be now to do a redemption of funds in the mutual funds or fixed income account in order to do the regular checkups as advised? And how long would it take to get the redemption? Essentially, is asking, how can you do your redemption and how long it will take? Then we have another anonymous attendee. And then it says it's not sure. I understand the example given to show the difference between T-bills and bonds. Per my calculations, it looks like the investment was the same for both. And then would go to the last one for now, Akosia Apia. And then she's asking, what steps do you take when you want to invest globally? I would add on Felix Ahosu again, and he's asking if global investment is risk-free. Ni, you can take these ones for now.
Okay, thank you, Doc. So I'll start with Richard's question. So as it relates to insurance, I don't see insurance to be entirely an investment product. most insurance products are risk products. So they're predicated on a certain event occurring, and that trigger then serves as an action for which you can make a claim. Now, lately, a number of these policies embed investment products to it, such that you can get a cash back, or after a while, they can promise you a certain, financial solution as in cash in hand to be able to move forward with. But it's from a risk perspective. I mean, it's good to have insurance policies. I'm not in any way shooting that down, but it's also possible that that risk will not crystallize, and depending on the type of policy that you take, that may mean money down the drain, or potentially, even if the event does occur, what you will get is just a fraction of what you put in. So that's my view generally on insurance. There are some good ones out there, some good companies with great policies out there. I wouldn't mention any particular names, but yeah, I think that's what I have to say as it relates to insurance, in particular. I think, but some of the questions have been tagged as I've responded to them, so I've lost them from my view. I believe there was a question. Sorry, I'm trying to locate after Richard's question, which other ones were asked. Hold on. Okay, yes, the anonymous attendees question on redemption from a mutual fund. So by law and under normal market conditions, you should take a maximum of about 5 working days for a redemption from a mutual fund or unit trust to take place. Now, the current condition as we speak is far from ideal, and that is caused in many cases by the DDEP and its resultant impact. So as to the ease with which that can be done for the older, larger mutual funds or unit trusts that may be available, it may be difficult to achieve this. You can go through your complaint process and bring the regulator and stuff in. But as you would realize that the regulator, even though they will follow procedure, they more or less understand the conditions that have caused some of these mutual funds to get into the situation in which they are in. It would be very unusual, though, for a fund that is practicing a different mandate, like a money market fund or a balance fund, to have the challenges of redeeming. If those challenges exist for those schemes, then perhaps that is worth like looking into and maybe questioning or maybe even escalating. Anonymous attendee that asked on the difference between treasury bills and bonds. So as it relates, the interest was indeed the same for both in terms of interest rate that was quoted. Let me just quickly scroll to that slide. So the interest rate quoted is the same, but note that for treasury bills, they have a tenor which is less than a year. In the example here, it's 182 days. For this bond in question, the bond was a 10-year bond. So the yearly interest you would get is 200. But if you're getting that interest for 10 years, you're getting a total of 2,000 in interest for the 10 years that you are holding the bond. Because you're only holding the treasury bill for 182 days, you're getting half of what you would get for a year, which is why you're getting 100 cedis over here. So anonymous attendee, I hope that answers your question on that front. I think so. I've answered.
If that clarity can come, so I'm just playing the devil's advocate for anonymous attendee since I'm not in his mind. So what would happen? The person holding the treasury bills rolls over also for the 10 years, unless you are trying to show that time is a big investment tool on this slide. But if all of them, held their fixed income assets, whether bond or T-bills, for the same duration of time, what would have happened with the interest? I think that was what he wanted to know.
Okay, so that's a good question. So I'll need to work that out, but per the math that I know, if assuming interest rates remain the same, even for the treasury bill, 20% per annum for 10 years, and the person kept reinvesting that coupon along with the principal each time for a 10-year period, the person should get an amount that should be greater than what the person that's holding the bond is getting, because there's a rate of compounding that is more frequent than just annually for the bonds. Deborah, you can confirm if you're in a position to. Yes, you can be heard. Yes.
Okay. Sorry. So
Yes, we can hear.
Similar to, okay, thank you for that. Just to add on what you said about the bill. So for the bonds as well, the interest rate is being paid semi-annual. And so if you also decide to reinvest and assume the interest rate is the same as the interest, then the two are supposed to give you the same amount at the end of the 10 years.
Deborah, please, your connection is a bit poor. Now we can hear you better. If you can start again.
Okay. Thank you. Okay, so I mentioned that in the case of bonds as well, interest rates are paid semi-annually. So even though you are holding the bond for 10 years,
No, the connection is
every
still
6
very
months.
poor. So, if you can understand what Deborah is saying, or you are
Yes,
mind,
I can. I get to Deborah's point. So she mentioned what she's referring to is that the convention for bonds is that even though your interest rate is quoted annually, the coupon is actually paid semi-annually. So every 6 months you would receive half. So in other words, your result could amount to the same thing as it relates to the bonds as well. Deborah.
Yes,
very well.
Okay, so that's it.
Okay. Do you have any other questions to answer so that
per what was I think I finished this round of questions as well.
Okay, then I'll go to almost the last ones. So I'll start with Audrey Adi. She's asking if you could briefly touch on real estate investment trust and if they are present in Ghana. Then Kofi Amokodie is asking, what do we do now that no one is even allowed to withdraw from the fixed income investment to be able to reinvest in other equities or even abroad? Then Mary Ann is asking, what are your thoughts on keeping foreign exchange as a means of investment? Prince Michael Henaku, that was very insightful. As a follow-up, could you reiterate on which firm or company that helps with investment in minerals, and then which precious minerals is worth investing in this current economy? Okay. Then anonymous attendee again wants to know what is the best way to invest globally.
Okay.
Okay, so
thank you.
We can leave it there for now.
Okay, so thank you, Doc. So as it relates to Audrey's question on real estate investment trusts or REITs, yes, they are present in Ghana. We have one very old one, which is promoted by Republic Bank. And then we have a relatively new one that is promoted by Sentinel Asset Management. What you should be looking out for in a REIT is an investment vehicle which is licensed by the SEC that invests in a pool of real estate assets. And ideally, the mandate of that vehicle would be to pay out anywhere between 85 to 90% of its earnings as dividends to investors. Now, as it relates to what you should be looking for, what you should expect, even though there are two licensed, remember I mentioned one very old one. I don't think it's been closely adhering to its asset allocation. So most of these assets would rather be, I believe, in fixed income securities. And I believe that it would have also been impacted by the DDEP. And then the new one that I just spoke of has exposure to just one asset instead of just a pool of different assets. I also don't think, as it stands now, that particular REIT is available for retail and investment participation. But yes, to the point, we have the legislation to support it, but we don't have an abundance of options available on the market. But it's just a matter of time before that happens. So that, Audrey, I hope that answers your question. On Kofi Amoko there, what do we do now that no one is even allowed to withdraw from the fixed income investments to be able to reinvest? Okay, I'm not sure I get your question entirely. But for I think trading conditions on the market for fixed income are a bit challenging, and that is what has caused there to be issues when it comes to withdrawing from fixed income investments. But the expectation is that if the Ghanaian economy does improve, that those trading conditions will also improve, and then it will be possible to realize your funds quicker in order to achieve reinvestment in other asset classes. So, Kofi, I'm not sure if I got your question right, but I have attempted a response, and I hope that's okay with you. On Prince Michael Hineku's question, so as it relates to the ETF, the exchange traded fund that I spoke of, any broker, because it's a licensed security on the Ghana Stock Exchange, any broker can help you acquire units of it. An account will be set up for you and the units can be acquired for you. That said, I think the main broker promoter of that particular security is IC Securities. So that could also help on that front. I believe I may have answered all the questions that have been presented, Dr. Kutampa. I don't know if there are any additional ones that you read out that I haven't captured or responded to.
Okay, so we are just about done. Just a few more, and then would close this session. So I got a prompt from Felix Ahosu that all his questions have been read, but none has been answered. One of his questions was, is it risk-free to go global. And then I'll look out for the other one. I think it's about how do you invest globally. That was the other question there about.
Okay.
So
Felix, my apologies. I couldn't find your question. So it's not risk-free to go global. I think the lesson that we should have picked by now is that there's no such thing as zero risk or risk-free. Everything has a degree of risk. The question really is whether or not you are willing and able to bear that risk. Do you understand it to know that this is how maybe you should operate or be measured when you are investing in this? There's no such thing as zero risk or risk-free anymore. And then I think the second question was what? Investing globally? How to do
how
so?
do you go about it?
Okay, so I think there are two aspects to it. There are certain platforms that can allow you to access. I've highlighted on this presentation 3 that I know of that will allow for you to do so as a retail investor. It's trickier as an institutional investor because of the KYC requirements of some of these Western countries. And for now, it's not as straightforward for an institution to be able to gain access to offshore markets. But for retail, so long as you're willing to disclose who you are, you may need some form of national identification like the Ghana card. And yes, it should be possible for you to use either of these platforms to be able to invest in Western markets. But there's no such thing as zero risk or risk-free as it relates to these ones as well.
Okay, thank you. So you missed out Mary Ann's question as to the keeping of foreign exchange as a means of investment. Any comments?
Well, okay, so the way I see it, I mean, we are in a country that the currency that we primarily use is the cedi. For most people, the currency they earn is also in cedis. Granted, as a country, we may import a lot, and as a result, we have imported inflation, and we also have the currency to sometimes deal with. It makes sense to try and store some of your value, your earnings power value in the hard currency. And why? Because I mean, 100 cedis today in dollar terms, you will not get the same value in that sense. So there's a sense of that as well. But assuming you are not to even do that, then there's a greater call on you to make sure that as a cedi earning person, that your money is invested to, 1, beat inflation, and 2, to beat the rate at which the currency also depreciates. Marianne, I hope that answers your question.
Okay. Thank you. Yes, thank you very much. There are just 2 more questions that I cannot leave unanswered. And one has to do with even the reputation of the GMA fund in light of the DDEP. So maybe one of the board members or even you, Nick, can answer it. So it's coming from Kalis Tego. How safe is our investment in the GMA fund in light of the DDEP? And then the final one, which would even summarize Ni's presentation for us, is coming from our anonymous attendee. As it is at this moment, considering the Ghanaian market and all that has happened, what would be your personal recommendation as to where a young doctor should invest his money with low risk and high dividend, supposing his risk tolerance is medium? And I think that is the crust of all the presentation we have had. So, Ni, if you can answer that one, then would put a close to the Q&A session from my end. So, any member of the fund, board member of the fund, responding on the safety of the GMA fund in light of the DDEP. Ni, you can help as well. But your last question is what I read out, then we can close. Thank you.
Sure. Well, I'll start with the first maybe, and then the board member can touch on it. So, in the context of what I said earlier on about there's nothing like zero risk or risk free anymore. The question really is what risks are you willing to bear? And we've tried as much as possible together with the IC and the board to fashion an asset allocation policy that will help guide our actions. And the very same IC holds us very strictly to each investment decision that we take. They demand and push us for research reports. They question, they interrogate, they push, and we try as much as possible within the best of our ability to react and respond to them, so that at least before we get into an investment, yes, we have an idea of what potential return there is, but equally, we have a sense of what the potential risks can be ahead of making that investment. So as far as doing what is within our power, our collective power, as a board, as an IC, and as a service provider is concerned, I believe we are doing as much as we can to try and make the investments that the fund has made on behalf of its members as safe as can possibly be. But yes, I mean, there are certain acts of God that perhaps we cannot hedge against, but we're doing everything within our power to make sure that we are delivering value and safety to that value as much as we can. As it relates to okay, let me pause now. Maybe a board member would want to add to that. But as it relates to my substantive question as to where funds can be placed, so there's no one size fits all strategy. Once again, it's a function of your own investment objective, the length of time you would want to invest for, and what your risk tolerance is. What we've tried to do in this session is to describe what, depending on the security you are interested in, or the financial asset you are looking at, what the characteristics are, and what it could mean for you to either take on or not do it. If you want a blanket recommendation, it will be difficult to prescribe one because everybody's preference is different. But through technology and some vehicles that exist, there are certain investments that have democratized investments. So yes, collective investment schemes is one. You can look out for one that has a money market underlying to invest in. You can look at certain collective investment schemes that may be investing in global markets. Those could equally also help you in your journey. And you could look out for other or such schemes that would allow for you to have a balance of risks. Some could be in money market, some could be in fixed income, some could be in equity to help you achieve certain goals and stuff. I know it may sound like a political response, but really, because the financial condition of each person is different, it will be difficult to just blindly prescribe one particular investment for anyone to have a look at. If there's maybe any key take home that I would say, it's good to diversify if you can accommodate a variety of these solutions depending on your goals. It will be good for you to have different baskets in which you invest in, and in the hope of each of those baskets fulfilling a unique purpose in your investment journey. I hope that answers your question.
Yes, please, and very elaborate. And thank you so much, Ni Ampa Sowa, for this brilliant presentation, and more importantly, the answers that you have provided that clarified questions for us. And would draw a close to this session and would want to invite the chairperson of the investment committee, Efwa Osio-Jemfi, to give us the closing remarks, in that quite a few other things related to the fund and also some other products would be mentioned and discussed, as we could not take them in the Q&A. Thank you and welcome, Madam.
Thank you very much, Dr. Kutuampao, and thank you very much, Deborah and Ni from Data Bank, for a lovely presentation and the Q&A session as well. This is, like I said when we're beginning, this is the first of a series of presentations we'll be holding for members in the course of the year. We call it the Financial Literacy Train, and we will continually do that till the end of the year. There were a few questions about on the GMA fund. The first one was when we are beginning the revolving fund. In our earlier presentations, we had mentioned that we hope to start by the end of the first quarter of the year, and we are on course to begin by the end of the first quarter, which is very soon. And I'm not sure, Dr. Kutuampao, was there any other question that I missed? I think that is the only one about the revolving fund, the loan scheme that we wanted to start for members.
Yeah, essentially that.
Yes.
As for the others,
Okay.
they have to do with the GME fund. So you can continue with your concluding remarks.
Yes,
Thank
please.
you.
So soon, very soon, Edward, our administrator, will be uploading how we can top up our contributions for the GMA fund. You can top up. There was a question about someone who wanted to know how he can continue to check his contribution. So far as you were a member and you still have your staff ID, you can go to the website and then log on with your staff ID, and you'll be able to view your account statement. This one goes for everybody else. You can check your account statements. You can access. You can have access to all our documents, our annual documents as well. They are all on the GMA website. Edward will be sharing it very soon. And then also, if you check our emails, the emails that we send on regular basis, you'll be able to access the GMA website from there, because the link is part of the mail that we send. Also, we've been sending out text messages about contributions. At the very end of it, you can have a link. You find the link that would take you directly to the site for you to make any changes that you'd want to make. So that's how you can do it. Edward, are you ready to share the link for the top-ups? Okay, so if you
Yes,
go to the
please.
website, you'll be able to also update us with your most recent email address and your phone numbers so that we can easily reach you. You can leave any messages there. We have Q&A, questions and answers, frequent questions and answers that people have been asking also on the website for you to be able to get a few answers to questions that you may be pondering over for some time. So that is it about the GMA fund. Thank you very much for patronizing our first financial literacy program. We are very sorry that some people could not log on. We have would make sure that the next time we can we open up the space for more people to join. It's unfortunate, but we're also going to make the recording available to every member to be able to go through, listen, and then if you have any questions, you can send it directly to any of the board of directors, the directors. You can send it to us on our personal numbers. You can put it up on the GDA platform. You can put it up on our junior doctors page platform as well, or alert any of us and we'll be able to answer your questions for you. Thank you very much for coming. Thank you to Data Bank. Thank you to our moderator and all board members for making this program a success. Over. Thank you.
Thank you very much, Chair. And would ask one of the board members, Selom, if you can help us with a closing prayer. Thank you.
Thank you very much, Dr. Ampa. Let's pray. Father in heaven, we thank you for today. We thank you for this opportunity to come and learn. Father, we pray that as we go back, you will help us to make financially prudent decisions that will yield us a good result in the years to come. We thank you, Lord, for the moderators and for all those who have come to join the call. For this we pray through Christ our Lord. Amen.